Now, let's compare the performance of Bitcoin and Ethereum on the same scale. To make the comparison meaningful, both assets are normalized to a starting value of 100. This means that we are no longer comparing the absolute prices. Instead, we are comparing how much as an initial investment would have grown or declined over the simple period. This normalization is particularly important because Bitcoin and Ethereum trade at very different price levels, but setting both series to 100 at beginning, we can directly compare their relative performance. The chart showed that both cryptocurrencies generated substantial appreciation over the long term, but their performance patterns were very different. Ethereum shows how much longer increases during several periods, reaching values above 300 and 3000 and even around 3500 in the strongest phases of the symbol. This means that relative to the starting point, Ethereum experienced significantly large cumulative gains during those periods. Bitcoin also experienced strong appreciation, but its normalized performance remained considerably below Ethereum's peaks. Another important characteristic is the cycle behavior of both assets. We can observe strong upward movements followed by substantial corrections. These cycles are particularly visible around the major market events highlighted in the chart, including the COVID crashes, Bitcoin's major all-time high periods, and the 2022 crypto winter. For example, during the 2022 crypto winter, both assets experienced significantly drawdowns. Ethereum's decline was particularly pronounced after reaching its previous highs. We can also observe that we assets do not always move with the simple magnitude, even, even though Bitcoin and Ethereum have strong positive correlations. As we saw early, correlations does not imply identical performance. This distinction is very important. Two assets can move in the same directions while producing very different return and experiencing very different levels of volatility. So the main takeaway from this chart is that Ethereum delivered substantially high cumulative growth from the normalized uh, starting point during several points, but this came with much large fluctuations and drawdown. Therefore, this comparison reinforces one of the central ideas of quantitative finance. Performance should always be evaluated together with risk and drawdowns, uh, rather than in isolation. Now let's take a close look at volatility. Volatility is one of the most important measures of risk in financial market because it quantifies the variability of assets returns over time. Using the daily return, we calculate annualized volatility for both cryptocurrencies. Bitcoin has an annualized volatility of approximately 60.55%, while Ethereum has a substantially high volatility of a 1.01%. This means that Ethereum has experienced considerable great variability in its return that Bitcoin over the simple period. We can also examine volatility across different time windows from 7 days to 365 days. For Bitcoin, the volatility increased from approximately 10.1% over the 10-day window to 43.1% over the 355-day window. Uh, for Ethereum, it's increasing from approximately 15.1% over 7 days to 64.2% over 365 days. The important point here is that Ethereum consistently exhibits high volatility across every time horizons in this analysis. For example, over 30-day windows, Bitcoin volatility is approximately 22.4% compared with 32.2% for Ethereum. Over a 19-day window, the difference becomes even more pronounced, approximately 33.7% for Bitcoin versus 48.9% for Ethereum. This reinforce what we observed early in the returns distribution and the rolling volatility chart. Ethereum has a high risk profile in terms of return variability. From a quantitative finance perspective, this distinction is important for portfolio construction, position sizing, risk management, and asset allocation. An investor cannot evaluate the two cryptocurrencies based on return alone. The volatility associated with those returns must also be considered. So, the key conclusion is that Ethereum has consistently high volatility that Bitcoin across all the time window analysis with annualized volatility of 81.01% compared with 6.55% for Bitcoin. This gives us an important risk dimension that we can combine with our previous analysis of return, correlation, and accumulative performance. Now let's move to another important measure of downside risk, drawdown. So, guys, a drawdown measured the decline in the value of a set from a previous peak to a subsequent draw. Unlike volatility, which measured the variability of return, drawdown focuses specifically on losses relative to historical peaks. Looking first at Bitcoin, the maximum drawdown over the simple period was approximately minus 76.63%. This means that at its worst point, Bitcoin declined by approximately 76.6% from previous peaks before recovering. The maximum drawdown duration was 846 days, which shows that recovering from major peak to draw decline can take a substantial amount of time. Now looking at Ethereum, the maximum drawdown was even large at approximately minus 79.35%. Ethereum also experienced a longer maximum drawdown duration of 1,382 days. This is particularly important because it showed that Ethereum not only experienced a slightly larger maximum loss, but also had a substantially longer period associated with its maximum drawdown. Looking at the charts, we can clearly see several major drawdown periods uh, through 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 the simple. The shaded the shaded areas illustrate the periods in which prices remained below their previous peaks. This analysis also highlights an important distinction between volatility and drawdown. Asset can have high volatility without necessarily experience a prolonged drawdown. Volatility measures the variability of returns, while drawdown tells us how severe and persistent a decline from a previous high can be. Therefore, an investor or portfolio manager, drawdown provides a very intuitive measure of capital loss and recovery risk. And comparing the two assets, Ethereum presents the more severe drawdown profile in this data set, a maximum drawdown of 79.35% and maximum duration of 1,382 days, compared with 76.63% and 846 days for Bitcoin. This reinforces our previous findings. Ethereum has high volatility and in this simple also experienced a deep and longer maximum drawdown. So when evaluating cryptocurrency investments, it is not enough to look at returns. We also need to consider volatility, drawdowns, and the time required to recover from significant losses. So, the final conclusions. To conclude this analysis, we have examined Bitcoin and Ethereum from several quantitative perspectives, include price behavior, return, volatility, correlation, cumulative performance, drawdown, risk adjusted return, and value at risk. The results reveal a clear picture of the risk return characteristics of these two cryptocurrencies. Both assets experienced substantial long term appreciation, but they also went through significant market cycle, sharp corrections, and period of extreme volatility. We found that Ethereum generally exhibit high volatility than Bitcoin, with annualized volatility of approximately 81.01% compared with 60.55% for Bitcoin. At the same time, Bitcoin and Ethereum have a strong positive relationship with a return correlation of approximately 8.8 through 0.832. However, the rolling correlation show that this relationship change over time, which is important when considering diversification. The drawdown analysis also highlights the magnitude of downside risk. Bitcoin experienced a maximum drawdown of approximately 76.63%, while Ethereum reached approximately 79.35%, with Ethereum also experiencing a long maximum drawdown duration. From a risk adjusted perspective, Bitcoin had a slightly high full period shape ratio, 0.491 versus 0.560 for Ethereum. However, The rolling Sharpe ratios demonstrate that risk adjusted performance can change dramatically across different market regimes. Finally, our VAR and CVAR analysis showed that Ethereum has great estimated downside and tail risk. At the 95% confidence level, the VAR was minus 4.69% for Bitcoin and minus 6.37% for Ethereum, while the CVAR was minus 7.41% and minus 9.98% respectively. Overall, this analysis demonstrates why cryptocurrencies evaluation cannot be based on returns alone. A proper quantitative assessment requires us to consider return, volatility, correlation, drawdown, risk adjusted performance, and tail risk together. These results also demonstrate the importance of analysis financial market dynamically. Cryptocurrencies risk is not constant, and market relationship can change significantly across different periods and market regimes. This analysis provides a quantitative foundation for more advanced applications such as a portfolio optimization, volatility modeling, risk forecasting, and systematic trading strategy. Thank you for following this analysis.